In this video, I will be discussing some of the differences between IFRS and US GAAP that relate to the accounting for and recognition of financial transactions. We'll start with an example to illustrate how differences in recognition rules can impact the financial statements and stakeholders' use of that information. IFRS rules for property, plant, and equipment require the use of something called component depreciation. Under component depreciation, a company must identify any significant components of an asset that will be used up at a different rate than the estimated life of the item as a whole. For example, the expected life of a building can be 30 or 40 years, but the roof of that building will typically last only 8 to 12 years and can be very costly to replace. IFRS rules dictate that the roof should be depreciated separately from the building. US GAAP rules allow for the use of component depreciation, but it is not required, and companies rarely choose to use it. Let's take a look at an example that will help us understand what impact this has on the financial statements. Okay, so for this example, we have SMC Company purchasing a building for $100,000. Included in this cost are $12,000 for electrical systems and $15,000 for the roof. The building is expected to have a 40-year useful life, but the electrical system will last for 20 years and the roof will last for 15 years. So we've got two parts here. For part A, we're going to assume straight line depreciation is used and compute depreciation expense under US GAAP if management opts not to use component depreciation. So remember, under US GAAP, they're allowed to use component depreciation. They just typically don't. All right, so we have an asset here. What's our asset? Well, it's the building. And that building cost us $100,000. And the useful life is 40 years. So again, assuming we're using straight line depreciation, as they told us to, we're going to take that $100,000 and divide by 40, because we don't have a salvage value in this case. So we're just going to spread out that $100,000 cost evenly over the next 40 years, which gives us an annual depreciation expense of $25,000. Sorry, $2,500. Okay, so that's pretty straightforward. Now, for part B, we're going to assume straight line depreciation is used again, but we're going to compute depreciation expense under IFRS. So remember, by saying we're going to do IFRS, that requires that we do component depreciation. So in this case, they've broken out a couple of components for us. So the first one is the electrical system. So our first asset is our building electric. Now, you guys can't see it because you can't see me, but I am the world's worst typer. So just roll with it. Sometimes there's going to be funny typos, and you guys can all just laugh at me later in the discussion section. All right, so the cost of our electrical system was $12,000. And our useful life for that one was 20 years. Now, they also said that we have a $15,000 roof. Okay, so we're going to add that as our next component, building, roof. And that cost $15,000, and it has an expected life of 15 years. So those are the only two components they told us about. So then what's left over? Well, everything else. So now we have the building other. So should this still be $100,000? Well, no, because we've already carved out $12,000 that we're going to depreciate someplace else and $15,000 that we're going to depreciate someplace else. So this one is going to be our $100,000 minus any components that we've already taken out to depreciate separately. So that's minus our $12,000 and minus our $15,000, which leaves us with $73,000 left over that's going to be depreciated over the full life of the building, which was that 40 years. Okay, so again, we're using straight line depreciation. So our $12,000 over 20 years is going to be $600 a year. Our $15,000 over 15 years is going to be $1,000 a year. And our $73,000 over $40,000 a year, over 40 years, is going to be $1,825 per year, which gives us a total annual depreciation of $3,425. Okay, so now we need to think about what impact this has on our financial statements. So under US GAAP, our depreciation expense is lower, which means our net income is going to be higher. So if we start thinking about the stakeholders that are using our financial statements, what would they prefer? So management, obviously, is going to prefer a higher net income because it makes it look like they're doing a better job. So management, when given the option, of course, is going to choose not to use component depreciation because component depreciation would have made their net income lower. Now, if you're doing our IFRS project, which remember is going to be a comment letter in which you have to write to the FASB. So say you're writing to the FASB and you're a manager and you do not want to have to do component depreciation. You can't say to the FASB, I don't want to do component depreciation because it's going to make my income look worse, right? They don't care about that. They care about accuracy and they care about how it's going to help the external stakeholders make decisions about your company. So you're going to have to come up with a better reason. So a better reason that management might say they wanted to do component depreciation or not have to do component depreciation is they might say, well, look, we don't think it's a significantly better disclosure to use component depreciation compared to the real costs we're going to incur of having to hire extra accountants to do all of these calculations, because this is a significantly more difficult and complex calculation if you have a lot of property, plant, and equipment. So you could say, we're going to spend a lot of cash doing all of this accounting when it's really not going to add any value to the investor. They could understand that our roofs are probably going to wear out before the building as a whole. And instead, we've taken this cash and paid for accounting when we could have used that cash to invest in new projects that would have led to better returns for our investors. Okay. So remember, you cannot use a self-serving motivation if you write your IFRS letter from management's perspective. Okay, so who else do we have? We have investors. So investors also want higher net income, so they might be pro-US GAAP. However, investors should want accurate financial statements because remember, in these two cases, it's the exact same transaction. We're just accounting for it slightly differently. And so to the extent that the IFRS version is more accurate, the roof is going to wear out sooner, we are going to have to replace it sooner, then the investor should want B because they should want the numbers that are going to help them make the best decisions about the company. Now, this gets a little bit dicey because if they've already purchased stock in the company, they have incentive to have higher returns, which will bring up their stock price. But if they're a potential investor, then they definitely want accurate numbers because they're trying to decide if they should buy stock. So again, this gets a little dicey. But if you're writing a letter to the FASB from an investor perspective, you again can't use a self-serving motivation. Well, I'm going to make more money if you use US GAAP. You have to say something about, you would prefer management to reinvest that cash in new projects. Or you have to take the position that you want the accurate reporting of component depreciation or some other position that you come up with that is not self-serving. All right, let's see. Who else? Creditors. So creditors probably would prefer, again, more accurate reporting, especially when it comes to figuring out the value of the assets, because what they're going to be interested in is a liquidation value. If we need to seize property from this company to pay back our loans, are they going to be able to do it? And so for them, they're probably going to want the more conservative reporting of component depreciation under IFRS. Then finally, we have another stakeholder group, the auditors. So the auditors are a tricky one because the auditors, what they really should be interested in is verifiability. So which one of these is easier to audit and be confident in their results. And so, again, the auditors might prefer not requiring component depreciation because that's going to be the easiest thing to verify. All right, I bought this building for $100,000. I see a receipt for $100,000. And sure, a useful life of 40 years, that sounds reasonable, looks good to me. But if you're doing component depreciation, you have to make sure all the components were identified, that the useful lives seem reasonable, and it's a lot more work. Now, that also could be good because they can charge more. But again, they can't say to the FASB, yeah, you should do this because we'll be able to charge more and make more money. So you have to kind of think about all the different motivations. And when you're doing your IFRS project, you're going to be really tempted to take the position of management. And I will tell you right now that management's position is probably the most difficult one. Auditors are also pretty difficult. So I would say that creditors and investors are probably the easier two choices, but just try to think through the motivations of those groups, which is why I have you take on a persona of one of them. And then also think about who you're writing to. Think about you're trying to convince a government agency. So you just say, oh, I think this is good for me. You have to say why it's good for the system as a whole. In addition to component depreciation, there are several significant recognition differences between IFRS and US GAAP that remain. Please pay special attention to the items with a star by them, as these are accounting topics that can be selected for the IFRS project. For inventory, US GAAP requires recognition at the lower of cost or market, where market value is defined as the current replacement cost. IFRS is slightly different in requiring recognition at the lower of cost or realizable value. The most significant difference regarding inventory, however, is that IFRS prohibits the use of the LIFO cost assumption. LIFO assumes that the most recent items purchased are sold first, thus resulting in a more accurate income statement because current costs are matched to the current sales prices. However, this means that the balance sheet is less accurate as older out-of-date inventory items or inventory values are recognized there. Further complicating matters is that when inventory levels run low, a LIFO liquidation could match very old costs to current sales prices, resulting in inflated earnings numbers. Absent a LIFO liquidation, and assuming general economic inflation, the use of LIFO is desirable because it results in a lower tax liability. Please note, this is important, the impact of financial reporting policy on taxes, the amount of taxes due, is unique to the election of LIFO. So normally a change in financial accounting, as we're talking about here, has no impact on taxes due, which are determined based on tax law, which is set by Congress. However, the LIFO conformity rule states that if a company chooses to use LIFO, it must do so for both financial reporting and tax reporting purposes. So to reiterate, this is the only difference between IFRS and US GAAP that would impact the amount of taxes paid by a company. And that's because there is a special law saying that the tax accounting must match the financial accounting. That's not normal. The next difference between IFRS and US GAAP is related to intangible assets. One of the major differences in this area is that under US GAAP, all research and development costs are expensed, while for IFRS, only research costs are expensed and development costs are capitalized. Consider the example of a company that is searching for the cure to cancer. Expensing of research and development is more conservative as most, if not all, of the company's work will fail to find the cure for cancer. This is, after all, a very difficult task. This method, however, ignores the fact that if successful, the company now owns a very valuable asset that is nowhere to be found on their balance sheet. Under IFRS, the company would be allowed to capitalize, or recognize as an asset, the development costs. These are the costs incurred after the research phase, when it is determined that the company did have the cure to cancer and is now capable of producing it at scale. Interestingly, under US GAAP, when a company buys another company, purchase accounting states that all of the purchased company's assets and liabilities must be marked up to fair value as of the date of acquisition. This includes assets not previously recognized, such as In this example, the cure for cancer. Therefore, US GAAP rules create a situation where the balance sheet of a company developing its own assets through research and development is not comparable to the balance sheet of a company purchasing its assets through mergers and acquisitions. For property, plant, and equipment, we already discussed the impact of component depreciation, but IFRS and US GAAP also have differences in balance sheet valuation. Under US GAAP, property, plant, and equipment is recognized at historical cost. That means the value of the asset equals the amount paid to acquire it. Under IFRS, a company may opt to recognize the property, plant, and equipment at fair value, but once they have done so, they must continue to remeasure the asset's value on a regular basis. This latter requirement is to prevent management from only revaluing assets when it is in their best interest, that is, when the value has increased. The revaluation option requires a company to record both increases and decreases in value once selected. The US GAAP position prioritizes verifiability and assumes that property, plant, and equipment was purchased to be used rather than sold, thus making its fair value irrelevant. The IFRS position, however, recognizes that some financial statement users, such as creditors, might find the fair value of the property more relevant and thus are willing to bear the risk of an inherently less verifiable valuation. Contingent liabilities are recorded under US GAAP when they are probable and estimable. If no estimate of the probable loss can be made, then the contingent liability is disclosed in a footnote but not recorded on the financial statements. IFRS rules do not record contingent liabilities, but do disclose their existence and the amount when estimable in the financial statement footnotes. Both the IFRS and US GAAP standards use the term probable throughout their various standards, including as a basis for when revenue should be recognized. This makes standards such as revenue recognition appear fully converged, except that the definition of probable is different in IFRS versus US GAAP. Under US GAAP, probable is defined as 75% to 80% likelihood, but under IFRS, it is defined as more likely than not, or around a 50% likelihood. That makes the IFRS standard much more aggressive in its revenue recognition, despite using the same words as the US standard. Sometimes, when estimating a provision, such as the allowance for doubtful accounts, there can be a significant amount of uncertainty regarding the eventual outcome. When companies attempt to make these estimates, they may arrive at a range of potential outcomes based on the assumptions that they make about future events. Under US GAAP, management should record the amount that they believe is the most likely outcome, unless all outcomes are equally likely, in which case they should record the lowest amount from the range of possible outcomes. Under IFRS, management should record their best estimate of the future outcome, but if they are unable to determine a best estimate from the range, they should record the midpoint of the range. In reality, the difference between the most likely outcome and a best estimate is probably not significant. However, the difference between recording the lowest point of a range versus the midpoint could be quite material. Great question, Annabelle. Students should focus on the differences listed here and the additional details in the IFRS handout, which is provided as part of the IFRS project and in-class activity for testable differences. This concludes the lecture on IFRS versus US accounting differences. Please remember to email any questions you might have for our discussion.